Alrighty. So, would you please tell us what is 1031 exchange?
Absolutely. So a 1031 exchange actually refers to the IRS code section with the same paragraph number. And what it means is that a business investor who's investing in real estate, when they go to sell their property and they want to use the proceeds to invest in a new property, they can defer all their capital gains tax by essentially swapping one investment property for another.
Oh, that is fantastic. And
There's actually, just going on a little bit further from that, an IRS code, the actual IRS code provision at the 1031, I can read to you exactly what it says verbatim. So it says there, no gain or loss shall be recognized on the exchange of property held for productive use in a trade or business or for investment, if such property is exchanged solely for property of like kind, which is to be held either for productive use in a trade or business or for investment.
fantastic. Thank you so much for citing the IRS codes. It's very important for people to understand specific verbatim. And from that, I want to ask you two questions. One is, can all property buyers take an advantage of 1031 exchange?
Okay, so no, a 1031 exchange is not for all buyers. So just to clarify for definition purposes, anyone who is purchasing an investment property, what is meant by investment property? So an investment property just means everyone who's buying a property that's not for use as their primary residential home that they're going to live in. Okay? If you buy a piece of real estate for any other purpose, that is what is meant by investment property, and a 1031 exchange only applies to investment property transfers.
Definitely, such as the rental or vacation,
Exactly.
rental. Yes, thank you so much for clarifying. And the second question from the IRS code would be, what means like kind property?
Right. So in the actual verbatim that I read out of the IRS code, where they talk about a like kind exchange, a lot of people, they narrowly construe this, thinking that like kind means they need to, if they have an office condo, they need to sell that office condo and they need to buy another office condo, and that's not the case. By like kind, it's actually a very broadly construed term, and it just means trading one piece of real estate for another piece of real estate. So it cannot be real estate being transferred for personal property. So you cannot sell farm equipment and then swap that for an office condo or an actual farm or a piece of land, because that's the trading of personal property for real estate. It has to be real estate for real estate. So having said that, it can be an office condo for a vineyard, and that would be considered like kind.
Well, that was a great example, and thank you so very much. I'm sure that helps a lot of people to see the options. Do you have any other examples in this case?
Sure. So it can be, something very varied. It can be a rental property that you own, that you're renting out to friends, getting some rental from that, and you can have that swapped for an office condo or for a restaurant space lease. That you would lease out. And what other people may not be aware of is that it doesn't have to be one piece of property swapped for another piece of property. It can be multiple parcels of land that are consolidated into, say, one huge office building investment, and vice versa, where you can break up one huge investment and break that up into multiple parcels of property too.
Thank you so much. That is great information, and I'm sure it's going to help a lot of investors to understand better what they can and what they cannot do. That being said, what are the limitations for 1031 exchange we have?
Okay, so for a 1031, there are some very strict timeline considerations that you have to keep in mind, and that is from the time the investment property is sold, you have 180 days to completely acquire the new investment property. Of that 180-day timeline, the first 45 days are necessary, and they give you what they call a time to acquire, to find a new property, a candidate for a new property. So they give you 45 days from the date that you've sold the investment property to go out and find a replacement candidate. If you go over the 45-day time period, a 1031 exchange won't apply.
Okay.
But if you do find a piece of property within that 45-day period, all the time after that, so those extra 135 days, the entire closing and the acquisition of the new property must be complete.
That's fantastic. And there's one more limitation we need to know about it when we exchange it, is where the property must be located.
Right, so in order for a 1031 exchange to apply, it has to be within the United States, the two investment properties.
Wonderful. All right, well, we do have some more questions from some of our customers and clients. And one of the questions is, does 1031 exchange apply to selling a primary residence and buying an investment property? I know you mentioned, but we would like to be a little bit more specific about it, so there's no questions or misunderstandings of that, please.
Great, and that's a very good question. So, can you sell your primary residence and then invest into a new investment property and do a 1031 exchange as part of that? The answer is no. So the property that is being sold and the property that is being acquired both have to be investment properties for a 1031 exchange to apply.
Fantastic, and thank you so much for making it absolutely clear. Obviously, to any transaction, there are more questions. Every case is individual, and you always can find us here to ask more questions. We will be very happy to answer all your questions. The next one is, what if I sell my 500,000 investment property and I only find a 450,000 replacement investment property? And what it means by boot.
Okay, so one of the requirements for a 1031 exchange is that the next property, investment property that's acquired, has to be of equal or greater value in order to completely defer the capital gains, paying the capital gains tax at that time. So if, for example, as in this question, you are selling a $500,000 property and you only find a replacement investment property that's worth $450,000, you're going to have a $50,000 gap. And that is what is meant by boot. Boot is that $50,000 gap. Now on that percentage, on that amount, on that 50,000, you will be required to pay the capital gains tax on that amount.
Okay, thank you so much. Unless you will be quick enough to find a second piece of real estate investment property.
And going on a step further from that, you can also avoid paying the capital gains tax on that $50,000 if you do choose to reinvest that into the property that you're purchasing, so that it would total to $500,000.
That's fantastic. And how do we actually do 1031 exchange?
Okay, so to actually do a 1031 exchange, you will need something called a qualified intermediary.
Well, then, can you elaborate a little bit on that?
Sure. So a qualified intermediary is essentially a third party, an uninterested party, a neutral party, which means that it cannot be your agent, it cannot be your CPA, it cannot be your attorney that's representing you in the transaction, because they're all interested parties. It has to be a qualified, neutral, third uninterested party. And these qualified intermediaries, they exist, and you can use their services, and I have plenty of contacts that are fully insured, bonded, that do these transactions all the time, but you would certainly need a qualified intermediary to effect a 1031 exchange.
So that definitely serves the purpose to protect the investor when they're doing transactions such as 1031 exchange. But some people still have a question, why can't they do themselves? Why do they have to have a third?
And that's also an excellent question. So the reason why you need a qualified intermediary is because the seller cannot handle or receive the sales proceeds from the investment property directly to their own bank account, because it's called constructive receipt, and this is an IRS term. Once you have constructive receipt as the seller of proceeds, it automatically triggers a taxable event, and they will be liable to pay the tax, the capital gains tax. So by having this qualified intermediary, this third party, the sales proceeds goes to them to be held in escrow, and then the qualified intermediary will also purchase the replacement property. So none of the money will actually be in the bank account of the investor itself. And this is why there's this safe harbor provision that allows the 1031 exchange to occur.
Thank you so very much. I think we got great answers for the great questions, and we will be very happy to hear back from you all, and we'll be happy to help you. That being said, would you please once more repeat to our clients and customers how can we find you, and what would be the best way to get in touch with you?
Sure. So you can contact me again. My name is Barbara Rhodes. I'm the managing attorney with MBH Settlement Group in the Reston branch. And you can either call our office on 703-318-9333, or you can reach me by email at B for Barbara, Rhodes, RHODES, @mbh.com.
Thank you so very much. Thank you again for listening and watching this video. We're looking forward to help you with your real estate investments. Thank you.